Hey traders, Nick Shaheen here, looking at the state of affairs in the stock market from Main Street's perspective. You've heard the Wall Street perspective on CNBC and all the other media. I'm going to try to put it in plain simple English, excuse me while I choke. So this is the S&P E-mini, so basically think the SPX, which is the index. So obviously we are having a tizzy. Number one thing I'd say, this is not December, because December we had Powell, the Fed, the U.S. Fed, as an adversary. So they were part of the problem. But this time they are going to be part of the solution, or at least they're on our side. By us, I mean the stock market side. Today, last couple of days, tizzy is over the rate, the yield curve. So here's the tricky part. Forever, as I can remember, CNBC tracked the 10s to 2s, the 10-year over the 2-year. When these invert, basically when the short-term rates invert, it's bad for the economy, and I'll explain to it. So now, for the last couple of days, we're falling on this concept, yield inversion curve. They say it's inverted. It hasn't inverted since 2007 or whatever the number is. Well, the big problem is the it factor. They used to track the 10s to 2s, which has not inverted, and I'll show it to you in a second. Now suddenly they are tracking the 2s to 3s. So the 2-year, I think, or the 10-year versus the 3 months. So they went way short on the short term. That's inverted, but that's also happened before. So they changed the stick, which is a valid point. Okay, the inversion of the yield curve is a valid point, but use the same stick. It's like measuring your kid with one ruler, saying, hey, he's growing, and then you measure him with a different ruler with a different sort of from inches to, hey, he got shorter. You can't change it without tying them together, tying them up. So the concept is, why is that bad if the rates invert? So first of all, the technical problem here is looks like a head and shoulder, and 2640 is doable. That's not my forecast. I think that this zone here is pivotal, and in fact, let me see here. Earlier, I did a trade. I took an overnight trade betting on leverage ETF for the small caps, okay? And I'll tell you the logic. If this is not December, we're having the same tizzy, right, as we did last fall. But if this is not December, then the worst case from December should be wrong this time around. So this zone should provide support, and this zone is below here. So for us to slice through this, we will need way worse news. Tangible news that's going to hit the P&Ls more than so we've already freaked out. So we sold Apple from its highs thinking it's going to zero because, oh my God, they're going to stop buying iPhones in China. Fine. 10%, 15% of its top line is from China. We already punished them way more than that. That 30% hit to the bottom line, I just don't see it mathematically. Maybe, hey, they're smarter than me. Anyway, back to the point that I'm trying to make, this inversion of the yield curve, it used to be this guy, the 10s to 2s. So basically the idea is, you see it's improving. So inversion is anything below 1. You can see here it's 1 point something, because then it's inverted where the denominator gets bigger than the denominator. In this case, we're dividing the 10-year yield by the 2-year yield. So if the 2-year yield is bigger than the 10-year, so short-term rates are higher, that's not normal. We've always known that, hey, if you lock in that CD for a long term, you get a higher rate, right? Well, in this case, they're saying, no, they're coming close to be opposite. So here's the problem, how it affects actual stocks, actual economies, okay? The theory is that the short-term rates become so high that the banks who borrow short-term to lend us, the companies, the consumers, money so we can go spend and build and expand companies and build houses and buy the houses. So they borrow short-term to do their business, which is lend long-term, right? So if short-term are higher than long-term, they're losing money. Why would they do it? They will stop borrowing to lend. That will cause the economy to stall. So again, if they're borrowing short-term and lending long-term, the inverted yield curve means that the short-term is bigger rate than the long-term. So they pay higher rates to take the money to lend it out. It just doesn't make sense. If I own the bank, I say, stop lending. Let's figure out something else where we can make money. So that stalls the economy, so you will get a recession. That's the idea. First of all, it's not immediate. Second of all, it takes, it's not a given. So now they're saying it's inverted. I think it's looking like this. This is the one they're looking at. Some sort of a, it looks like this. It's not here. I tried to look it up. I failed to find the actual ticker to do it. But if you can find it on your in your platform, it's basically they're using the 3 months as the quote short-term indicator. So back to my original point that this is not the time like December. So in December, the Fed was still on quote cruise control and rate hikes, right? Which makes it worse because they control the short-term overnight lending rates. So that will add to our problem of higher short-term. Well, in this case, now they're more likely committed to cutting rates, and they control the short-term. So more likely the impact of rate cuts will help this inversion yield curve problem from happening. So whatever we're fearing now, the Fed can save us. So that's the big difference. And that is why I think that if you stop the new headlines, well, every day we've got a stinking new headline. Today we find out that Mueller is, resigning and closing his shop. So that means that there's a big question there. So assuming that there's no new shoe to drop, this tizzy is not doomed. I'd be shocked if we A, revisit these lows, or B, even lower. So these are 2,300. That's pretty dang low. I said that if we lose, to people that read my notes every day, 2,800-ish, it's actually a little different, but let's use round numbers, 2,800-ish, 2788-ish would be a level to watch, but 2680, 75, 88, those are numbers I remember offhand. Let's call it 2680 is doable, if not 47, 45. Okay, so these are just pictures off. I'm looking at them and I can revisit those lines. Technically speaking, okay, head and shoulders, that's the size of the dip lower, so this is the zone we could hit. Not the end of the world. How cheap would Apple be down there? How cheap will Google be down there? How cheap will Amazon will be down there? So there will be buyers, unless you tell them there's something completely different that we yet don't know about. But from the fears we have, this zone here, I bet you will be strong support where buyers will step in. Now you have to listen to the talking heads on CNBC. That's your prerogative, but don't let them make you make mistakes. So know the issues at hand, and in my opinion, if they're fearing from this yield inversion thing, why don't you track the same one you've been tracking before, which is this one? Okay, so yes, it's lower, but it's holding a bottom, and this is consolidated for a while, so every time we get here, we hold. So why is not the assumption now that the yield curve has not inverted yet if you still look at the same stinking measuring tool, which is the tens to twos? You've heard it, Santelli all the time say, tens to twos this and tens to twos that. They switched to a different measuring tool completely without telling anybody how the two tie in together and why they made the switch. Maybe they have a reason. Just educate us on what that reason is. Don't just switch the measuring stick and create a headline that sells. Oh my God, the yield curve is inverted. That hasn't happened since 2008. By the way, that's not the same yield curve we've been tracking for the last 6 months or a year or two. That's a new yield curve we just made up because it makes for a better headline. That's my own opinion. So how we close today is important, but if I were to short or go long right here, right now, I would go long versus short and just pick good stocks. And there are tons of good stocks at pivot points. Pivot points are usually, they create congestion. So if you have a pivot point, say at, I'm going to pick something, I don't know, Google. Okay, so Google. This again is also a neckline that could pretend lower prices, but it is a pivot point. Look, it's played a role in recent history. It's a 50%, it's a halfback test, basically. So simply stated, this is a rally. If I cut it in half, somewhere around here, this zone is the halfback. So they fell into it, and this is a ledge, right, from which we fell a while back. So if this was wrong and this was wrong, somewhere in the middle lies the truth. So it creates congestion. Bulls and bears will fight it out somewhere here. So this should be support, unless we get a new shoe to drop, right? So all these stocks, I'd be glad to hold Google calls out in time, overnight, or for 2 or 3 days. I'd buy them or buy the shares and put a stop loss below it. What do I get to lose? A little bit. It's an educated guess as to what quality stocks will hold up. I haven't looked at Amazon in a while, but these are just, they all kind of look the same. Apple probably is the one that shed the most fat. Same thing. Look how pivotal Apple level is. Okay, so Apple has a special case because it's a target of headline and it's held hostage that way. But AMD can't fall for some reason, and it's the frothiest of them all. So the SMH is doing okay today. Let me see here. Yeah, it's up on a bad market day. Okay, so talk about the SMH. Boy, this is getting to be longer than I wanted to. I should stop now. But anyway, pivot point, right? Look at this. This is where we are. So they fell, they tried to hold, they fell, they tried to hold resistance here, they went up and they proved it as support and they went up, and here they are. So it's not a hard line in the sand, but it's a zone. All right, enough of it. The message is bonds are the key. The different time frames are key, and if the media wants to sell us on the fact that this is the spooky thing to fear right now, I don't buy it. So I think the Fed is on our side this time, and I think they can bail us out of it. So if that's the fear, I think it's just a temporary tizzy and it will pass. I shouldn't trade on it. I shouldn't change my thesis on it until the actual stocks I'm in, the tickers I'm in, actually show me levels that are breaking down and technical reasons to exit or fundamental reasons to exit. Example, Goose. If I was long Goose, today's earnings report makes me get out of it or manage out of it, because technically I want to catch this falling knife. But if I went long it because it's a growth stock, they missed on the sales line, which is a growth company's no-no. They can miss the bottom line. Amazon did it all the time. You can miss on profitability because you're a growth company. You spend to make a living, to grow your stock, to grow your sales, and your stock follows. So Wall Street gives you a pass on 60 PE, 70, 80 PE, whatever it is. Well, now the PE is 50 something. That's still high. Why? Because they told us 2 years. They downgraded the guidance, I think. I didn't read the whole report, but that was the headline. For 2 years. So they're basically telling Wall Street, I am no longer a growth stock for 2 years. So you're probably going to have to sell my PE down from 50, from 70, wherever it was, down to like 30, if not lower. So that's I wouldn't catch this falling knife. There are better falling knives. Nike, definitely better. Look how pivotal that is. Definitely a longer video than I wanted. Anyway, you get the idea. Nick signing out.